Thank you, everyone. My name is Hugh Chung, CIO of Endowus. I'm so glad that everyone is still here. I'm acutely aware that this is the last session and the only session that is stopping you from, getting your drink. So we'll make it interesting. We'll make it punchy. Thank you, everyone, esteemed panelists, for joining me on this session. Maybe we'll start by having a very, very quick intro of each one, maybe starting from Richard.
Thanks. So pleased to be here. My name's Richard Chan, representing Brookfield Oaktree Wealth Solutions. So as our name implies, we are a wealth-dedicated platform working with partners like Endowus, and our goal is to bring the flagship strategies of both Brookfield and Oaktree to this space. Our firm is best known for our $1 trillion AUM in alternative assets. And on the Brookfield side, we're focused on real assets such as real estate and infrastructure. And on the Oaktree side is, of course, our credit capabilities. So looking forward to bring more alts to this region. Thank you.
Hugh, thank you for inviting me to this event. My name is Joe, and like Hugh yourself and everyone here, I'm also looking forward to happy hour after this session. So hopefully this session can be punchy and fun. Just a quick introduction about myself. So I'm a principal at Carlyle AlpInvest. As you can see the name, there's two different names. There's one is Carlyle, there's one is AlpInvest. So when you think about what AlpInvest actually do and what we do, we're the investment solution and a fund-of-fund arm within Carlyle Investment Partners. So for us, our main business is threefold. One is really on the primary side, the second one is co-investment, and the third is secondary. Primary is investing into blind pool GPs, where these are the best of GPs in the world. Co-investment is investing alongside these GPs on new deals. And the last part where I sit, where I'm obviously the segment that I love the most, is on the secondary side, where we provide liquidity to both GPs and LPs.
Hi, we've already had one date, so hopefully you remember my name, but if you didn't, Neil Johnson from Macquarie Group. Macquarie's a global financial services organization that manages more than $650 billion of assets under management across the public and the private space. Within the private space, we're most well known for being one of the leading players in infrastructure investment and as being one of the pioneers of the space dating back to early investments in Australia in the 1990s. So look forward to sharing more about our experience with you as we go through the talk.
Thank you. My name is Vicky Yick, and I head the Greater China Private Wealth business for Partners Group in Asia. Partners Group is a $150 billion private markets manager headquartered in Switzerland. We invest across the spectrum, including private equity, private infrastructure, private credit, private real estate, as well as royalties. Partners Group is known for two things. First thing is our deep experience in the evergreen space. We launched our first evergreen fund 20 years ago, and we now have over $50 billion in that business. Secondly, we're known for our private equity as well as private infrastructure business, where we focus mainly on the mid-market space. We've been delivering consistent top quartile return for our investor. Super delighted to be here and happy to be at this panel.
Yeah, so you're all in luck today because we have an esteemed panelist group that is really representing all the asset classes within private assets. I'm going to start with private credit, Richard, because we're on the heels of the last panel talking about public credit mainly. And there was a lot of comments on how yields in the public space is actually very, very compelling. So I guess my question to you on private credit is that it's really been a rapidly growing asset class over the last few years. And it enjoyed, you yourself said in your 1-minute speech, 10% yields, and it was even higher in the last 2 years. So there are concerns that base rates may come down and that attractiveness may not be the same, and there's been a lot of money raised in that space as well. So how do you assess that attractiveness of the asset class? So if you can speak to maybe the pros and cons of being an exposure to private credit, particularly relative to public as well, that would be very, very helpful.
Sure, thank you. So I've had to change my responses 3 times in the last 2 days. So I think, let me break it into a few questions there. So two answers. I think one on base rates. So there was, prior to this week, a concern that base rates are gradually coming down. But as what we've seen in the markets in the last 24 hours, that remains, I think, uncertain, right? So we're not ruling out a possibility that base rates may just remain higher for longer, and even to a certain degree of some room to move above, because the inflation pressure is still strong. So I think people should not lose sight of that. And the other scenario where base rates is slowly crawling down, that is not something we're overly concerned, because again, as I was saying, private credit is yielding 10%, right? So there's a lot of room for that to move before investors should be really concerned. And also picture a scenario where the base rates are moving, say, by 100 or 200% basis points down. Imagine what the scenario of the economy would be, right? So that's not a pretty scenario. And I think if that case does happen, the economy must be going through some kind of struggle, so that the investors should be feeling a lot more, I think, should be more concerned about the overall credit conditions than to worry about what type of yields they're getting overall. And if it's a gradual move, then as we continue to reinvest into a higher yielding environment, then you could recuperate much of the yield that you get. So ultimately, it's the credit that matters the most. And there are still a lot of levers for us to pull. So whether it's from the monetary side, from the government side, or even from our own fund. Right now, our leverage ratio is very low. We're operating at below half a turn, right? So if the base rate is gradually lowered, we can always turn that up to complement the return that we're getting. And just the last point, again, go back to a scenario where if the base rates are cut by 200 basis points, then your relative income from IG or high yield would be much, much lower. So from a private credit angle, you're still getting that extra yield pickup, and you're still benefiting from structural advantages such as the structural protection in private credit, as well as the diversification. The last point on the proliferation of credit, and of course, I think everyone knows that's been a booming market and has worked tremendously well for investors. And there are many reasons for it. I think just to name a few, number one, Asian investor likes yield, right? So if you like 6% bond yield, you love 10% yield on private credit. And also what we're seeing is that by having a vehicle where there's no mark-to-market risk or as much mark-to-market risk, it enables you to remain sort of more disciplined and stay invested, right? Which is something we always preach to investors. The one con that not really a con, but maybe something that people should be cautious about is that this market is becoming crowded. So this whole proliferation of private credit has seen a lot of new entrants from entry of players that perhaps were not always in private credit. So there is a scenario where lenders are forced to lend to who they can and not who they want to. And that creates some problems. So you want to make sure your managers are disciplined, are conservative, and they have been through crisis. I can spend another hour to talk about those three things, but just one takeaway, look for management firms that are old, right? Because an old management firm by default would have been conservative, would have been disciplined, and must have lived through multiple crises. Thanks.
Thank you for that. I'm going to turn to private equity now, and private equity has seen a bit of a different picture over the last few years. The exit markets, the M&A markets, IPO markets have all been very weak. There was a lot of expectation going into this year in the Trump administration that things will improve. And that didn't quite happen that way, particularly with the markets coming down. So I guess I'll turn to Joe first. How has this affected your business? And I think the secondary side is obviously seeing some opportunity there as well, but like, where do you see the largest opportunities within private equity?
Yeah, Hugh, I think that's a very good question. And look, maybe I can also give you a quick background of what secondary is. So secondary in a nutshell is basically when an LP commit to a Oaktree, into a Blackstone, into a Carlyle funds, and after 4 to 5 years, they want to find liquidity. If you bought in a public stock, if you bought in NVIDIA, you bought in Tesla, you can just sell it on any exchange, anytime, anywhere. But if you commit to a private equity fund, it's actually a little harder to sell it because there's only a limited buyer set. So what I sit in is we're really providing liquidity for both LPs and GPs. So looking in the past 3 years, this is the 15 quarters of consecutive net capital calls for LPs. What that means is that the private equity market as a whole has been calling more capital than giving out distributions. So what does this create? This actually creates an imbalance of their private equity portfolio to the rest of their portfolio book. So looking at what the secondary market is right now and compared to when I first joined 13 years ago, secondary market was roughly $25 billion market size. Last year, it was $160 billion. So over the last 13 years or so, this market size has really grown 6x. And I think a little bit more history is also useful. If you think about secondary market, we're roughly a 30-year type of asset class. The first 10 to 15 years was really driven by regulatory sale. These was Volcker rule, bank issues, really banks selling the private equity book to secondary buyers like myself. Then from 2011 to 12 to roughly to 2020, a lot of the volume in the secondary market was opportunistic sellers. When I say opportunistic sellers, this could be a new CIO at a US pension fund coming in saying they want to change the investment strategy, so they're changing their private equity allocation. What we've seen in the last 5 years is secondaries is becoming a toolkit for all LPs and GPs, so they'll use this every single year to really sell their portfolio. So when I think about the market size of secondary market, 160 billion, I think that's really just the beginning of what we're going to grow over the next 4 to 5 years and even 10 years. One of the biggest opportunities that we've been seeing in the last 12 months and also the next 12 months is really the emergence of first-time sellers. In the US and in Europe, all the big LPs have sold. In Asia, where it's close to our heart here, most of the LPs have not sold. A lot of the LPs from Asia that have sold last year, roughly half of them were first-time sellers. Every single week right now, every single day, I'm actually talking to sellers right now, trying to see what kind of portfolio that they can sell right now. So I think that's actually going to drive a lot of the deal volume over the next 5 to 10 years. It's really both the repeat sellers in the US and Europe and also first-time sellers accessing the secondary market to rebalance their portfolio.
So let's stay in private equity. I'm turning to Vicky. You were talking about secondaries, Joe, but on the Partners Group CCAP funds, obviously you have a lot of directs. You have secondaries as well, co-investments. Again, a similar question, but how are opportunities in secondaries kind of relative to the direct investments opportunities right now, given Partners Group has been doing evergreens for a really long time as well, just to understand the perspective in terms of how interesting the asset class currently is.
Right, sure. Maybe I'll take an example of the evergreen fund that you mentioned, the Global Value Fund, and talk about how these different components work together and complement each other within a portfolio. So firstly, we have direct investments. So when we acquire a direct stake in a company, what we usually is to opt for majority ownership. Majority ownership allows us to have control over the company, and we can take a hands-on approach to value creation. What we can do is to improve the operations, to enhance the sustainability, also do platform building. And with direct investments, you usually would expect a higher return, generally to 2 to 4 times return for investment, and sometimes even higher. An example is that there's this Indian retailer that we invested in back in 2018. Some of the value creation activities that we did include helping them expand the number of stores significantly across the country. We also helped them with creating their private label products to increase their margin. We also helped them with supply chain management as well. So we managed to exit the company back in 2024 in December, and we made 7 times for our investors. So that was the largest IPO in India for a private equity manager as well. So as you can see with direct, is in the portfolio context, it's a return generator. And that's why we usually have the biggest component. And we complement direct investments with secondaries and primaries. So obviously with primaries, why we like it is because it gives us diversification within the portfolio. We can invest in specialist managers that we're not experts in. But obviously with some of the disadvantage with primaries is that it takes 10 years or 10 plus 1 plus 1 or longer, and you also have your J-curve effect at the beginning where you have your negative cash flow. And for secondaries, the good thing is that you're investing, like what Joe mentioned, you're investing at a later cycle of your portfolio, of the fund, and you're investing at a cheap, at a discount. And it really gives a much faster cash flow distribution. So when you put direct primaries and secondaries together, while your direct and primaries are at negative cash flow, your secondary is actually already giving out cash flow. So when you put these together, you have a natural flow of liquidity coming through, and this becomes a very robust portfolio. So all in all, there's pros and cons with these, and they are different components in the portfolio. But within the Global Value Fund, they really complement really well each other, and basically their pros are enhanced and their cons are basically mitigated.
Okay, so what I'm hearing is that private equity is still, I guess, in a traditional sense, probably not out of the woods yet, but there are a lot of opportunities within secondaries as there are a lot of sellers, and then if you have a diversified portfolio, it'll obviously help as well. Let's move on to infrastructure. I think, unlike private equity and private credit, I think people may be slightly less familiar, but infrastructure, I think, traditionally means toll roads, utilities, et cetera, but recently it's been data centers and even fiber and all of that. So I guess turning to Neil, could you give us a definition of what you think of as infrastructure and what role it plays in a diversified portfolio?
Sure. I think the best way, as I alluded to in the prior session, is think of essential services and facilities, the things that make societies and economies work. So traditionally, infrastructure was viewed as water and wastewater treatment or toll roads, airports. Now, one of the hottest sectors within infrastructure is digital infrastructure, which is data centers and fiber. And these are all things without which economies just cannot function. And so I think as the sector evolves and grows, one of the things that's happened is that we've bifurcated how we look at infrastructure. It's become more sophisticated. So for those traditional regulated asset classes like water, wastewater, toll roads, where you have a concession with the government, we within Macquarie, we call that core infrastructure risk today. And that's a specific risk bucket. And then for a lot of the things like digital infrastructure, sometimes we're taking on commercial counterparties under long-term contracts. And so we would bucket that within what we call core plus risk. And so as the sector evolves and matures, we're already bifurcating the risk profiles that we're investing into. And I think one of the definitions of a good manager within infrastructure is the ability to understand and price risk. And I know that that's a fundamental to every asset class, but within infrastructure, really not all infrastructure is equal, and you would expect a different return for a data center business versus a regulated water utility. And so when you're thinking about which infrastructure managers to allocate to, track record is obviously a key consideration, but when you look at track record, you've really got to consider that in the context of the risk that portfolio is undertaking. And I guess, as we'll talk to in a bit, the latest evolution of the infrastructure space is the move to evergreen structures as well. And so again, that's a very exciting new growth area for infrastructure investors because it enables us to begin talking with retail and high net worth investors. In terms of the role it plays in a diversified portfolio, I alluded to this previously. Infrastructure has low correlation to other asset classes, and so there's a natural portfolio diversification benefit. But I think as you've heard me talk, you would understand water and wastewater or core utilities don't behave in the same way. They have a beta of less than 1. So in times like these, where we're experiencing high macro volatility, infrastructure assets are seen as something of a safe haven. And so we would advocate that you had all of your portfolio in infrastructure, but it certainly has a core role to play as a part of a diversified portfolio. And to give you a sense, I think institutional investment allocations to infrastructure have been rising over time. And typically what we see today is around 5 to 10% allocations to infrastructure is quite common.
Thank you for that, Neil. Actually, can I stay with you for a minute?
Sure.
Just to ask you about evergreen, since you mentioned it, and we had this whole session with iCapital, who's helping us with access to these evergreen vehicles. In terms of infrastructure, I mean, a lot of them are actually quite long duration assets. So how do you manage the cash flow for an evergreen product?
Yeah, it's a great question. I think the first point to note about the evergreen structures is that they're not a completely liquid product. We would say it's semi-liquid, so redemptions are capped on a quarterly basis, and typically there's a lockup period that investors should be aware of around 2 years before those redemptions can start to take place. But you're right, I mean, there is a natural mismatch in duration potentially, given that some of our government concessions are for 30 years. And so the way we manage that risk is to have a portfolio that's constructed primarily of private infrastructure investments, but we have a sleeve of government bonds and also public infrastructure investments so that we can manage that liquidity. And I'd also add that we typically manage redemptions on a net off basis against capital commitments into the product. So it's through that portfolio construction that we seek to meet those redemption requests on a quarterly basis.
So I'm going to move to Vicky on, obviously, Partners Group has been the pioneer of evergreens. What are some of the lessons that you can share with the audience of running evergreen strategies for so long?
Sure. Thanks for pointing out the fact that we've been in evergreen business for a long time. And, and we've gone through different market cycles and never had to gate any of our investors. So sharing some of the lessons that we have learned before, firstly include access. So in order for your evergreen platform to be sustainable, you need to have access to basically direct investments and secondary investments. Having your own direct investments gives your portfolio manager a full visibility on what type of investments come in next so that he can actually better manage the cash flow. But then imagine if you only have direct, it's not enough for you to deploy all the cash flow that's coming in on a monthly basis. So you need secondary to basically ensure there's a consistent deployment and keep your investment levels up. So secondly, there's also, the second lesson is fair allocation. For all of our evergreen investors, they have fair allocation or fair access to every single investment on the Partners Group platform. So they're investing alongside with our institutional investors in our closed-ended fund and also in our bespoke solution as well. So there's no cherry picking, and this will ensure our evergreen fund can also keep up with the same performance or even better with our closed-ended funds. And third lesson is you need to be disciplined. You need to be disciplined when you grow your fund. If you grow your fund too fast, you might face dilution of your existing investors' interest in the fund. And at the same time, you might also face over-allocation to certain vintages. And you don't want that. You want a vintage diversified portfolio with assets that are at the beginning of value creation, some in the middle, some that are primed for exit, such that there will be cash flow coming through so that you can deploy into new investments and also meet some of the redemption requests as well. And last lesson, super important, and most people don't really talk about it, is that you need to have a proper portfolio investment team to manage your portfolio. People ask us, who's your portfolio manager for your private evergreen funds? And they expect to see someone super senior who's in the investment team managing the fund. But that's not the case how we do it in Partners Group. We have a team of dedicated people, of over 30 people, to manage the portfolio. And what they do is not just balancing cash flow or FX. They do a lot of stress testing. They do a lot of risk management. And there's a lot that they need to do. Imagine within an evergreen fund, you have subscriptions, redemptions. You also have your underlying funds, capital call, and also cash distribution as well. So it's a really big and a complex way to manage evergreen funds. So with all these lessons, without any of them, your evergreen portfolio will not be able to be sustainable.
Thank you for that. So Joe, staying on private equity evergreens, it does seem like secondaries are quite a good match for evergreens given the lower J curve and the fact that it's diversified. I have a question though, which is secondaries funds have really been the liquidity providers for a lot of the primary funds at a price, or LPs, right? Mm-hmm. Now with the kind of proliferation of evergreens, does that change? I mean, will evergreens be the liquidity provider, or does it not change? And do you have any thoughts on that?
I think that's actually a very good question. So I would say in the last 12 to 18 months, what we've seen is that all these semi-liquid evergreen products coming into the secondary market, I would say they focus a bit more on the tail-end funds instead of the early younger funds. And tail-end funds, what does tail-end funds mean? These are private equity funds that have already been investing somewhere plus 10 years old, where these evergreen funds will buy at a discount. Our strategy has always been focused on younger funds, higher quality funds. So anywhere between year 4 to 6, where they're still entering the value creation stage instead of full harvest stage. The pricing on tail-end funds have definitely increased with the evergreen coming into the market, But I would say for the younger vintage funds, I think that it's business as usual for us. I think the biggest thing for Carlyle and also at AlpInvest for our evergreen structure is whatever goes into our evergreen structure, similar to Vicky, it also goes into our evergreen as well. So there's no cherry picking in terms of deals. So we're going to make sure that every investor get their fair allocation. But you are right that the evergreen structure is becoming a bit more bigger firepower for existing secondary players. The one thing I do want to caveat is that the evergreen structure is not becoming a competitor. It's still the same competitor set. I'm still competing against Partners Group. I'm still competing against other secondary players. And why is that the case? And the biggest reason in the secondary market is data and how much data you have. To enter into the secondary market, you don't need just this year data. You need 10 years, 20 years of data, and you also need a relationship with GPs. We have invested over 1,000 different funds. We have data set over 20,000 different companies. So that data is very hard to replicate. So when we want to buy a portfolio, we can see what this company has done this year, what it has done last year, what it has done 5, 6 years ago. And we can also track, how accurate has been the GP telling us about the returns. So while evergreen does increase the firepower for the secondary market as a whole, it doesn't add new competitors to the entrance.
Okay. Turning to Richard, I think compared to private equity, private credit, I think as a proportion of its total assets, a lot of the growth has actually been driven by some of the BDCs and evergreen structures within private credit. So, how do you think about this structure vis-a-vis the closed, traditional structure of private credit? Do you think it fits quite well, given the nature that it's really yielding and there's not a lot of change in NAV? And could you talk a little bit about how well fit it is for private credit managers to use evergreens?
Great point. So I think unlike some of the other asset classes, private credit itself tends to fit better in a BDC structure, in a sort of evergreen vehicle, as we called it, just by nature, because these are loans, and these are often loans come with coupons. And again, the income, the yielding nature of credit is something very different than the other asset classes, because when you boil down to it, what credit is contractual obligation to pay, right? If you're a company and you miss a dividend or you don't buy back your shares, there are ways to get around that. But if you owe a credit and you don't pay, the downside is very severe, right? So there are a lot of things we can add in to ensure that the cash flows are coming on time. For example, we can add in structural protections, we can add in covenants, we can go in as first lien, senior secured, meaning that if you don't pay, we can seize your assets, or we can have a lot of levers to pull to enforce that. And then to get back to the evergreen structure itself, it just helped to alleviate a lot of those obstacles that investors used to have. So back then, even in private credit, you had a lockup structure of, say, 10 to 12 years, which was just far too long, right? And secondly, you had to deal with J-curves, capital calls. But again, in a BDC structure, in an evergreen structure, you bypass all of that, and you still get the same benefits as some of these other vehicles, such as the low volatility in NAVs, the high income, monthly income, and lastly, just acting with the low correlation as a good sound base in your overall portfolio, which is especially important given the markets that we are in today.
Thank you. I'm going to actually turn to some questions from the floor. There's actually a question that I think either Joe or Vicky could answer quite well, given that you have a lot of visibility into other GPs, is that how do you distinguish between a good PE fund and a below average PE fund, given that there's a lot of disparity? Any one of you want to take the question?
Maybe I can go first. Look, I think that's actually where we spend most of our time in both on our primary side of the business and also secondary side of the business. I'm actually on the investment side instead of sales side, so I deal mostly with GPs, and our biggest thing is actually trying to figure out which one's the high quality and lower quality GPs. In a rising tide, it's very hard to differentiate because everyone does that very well. I think when there's market volatility, that's when you know the good GPs from the bad GPs, and it might be what are they actually doing with the portfolio once they actually go into an issue. You saw COVID happen, we saw the Ukraine issue happen, and we also seen the rate hike increase in the second half of 2022, and now also we're seeing the tariff issue. When there's market dislocation, good GPs will add value to the portfolio company. How are they adding value to the portfolio company? The easiest way is, this might not be a great time to exit. Let's do buy and build at a lower valuation, so you buy down your valuation. That's number one. Number two is, how can you actually pivot the portfolio company to a higher growth sector? Maybe you're in a traditional auto OEM, you pivot that business into more EV-oriented end sales. And the third thing is, what are you actually upgrading in terms of the tech stack for the portfolio companies? How are you upgrading the management team? I think those are the things. It goes through history, knowing the GP, knowing that they can actually go through cycles and improve their portfolio companies during the bad times. In good times, to be quite honest, almost every GP look the same because their returns are 20% net, good DPI for everybody. But when times are bad, that's when you see the bad GPs IRR deteriorate, and the good GPs, their IRR is either staying flat, which is at a high level, or they're actually still compounding at a very good level. So I think right now in the last 3 years, it's making our job a lot easier because the bad GPs are identifying themselves right now.
Anything to add, Vicky?
Sure, yeah, I concur with what Joe mentioned. It is really when there's market dislocation where you can distinguish between, who is a good private equity manager and who is a mediocre manager. Maybe citing an example with Partners Group, private equity capability. So what we've been doing throughout COVID, so obviously it's been difficult times, but we continue with our disciplined hands-on value creation, and improving the operations. For example, we have taken the time during COVID, because we have control, to diversify the supply chain management and also to not rely on just single supplier. And because of that, now we're seeing with what's tariffs that's happening, we're pretty comfortable in terms of a lot of the portfolio companies that we are invested in. They're not too much impacted by all the increase in tariffs. So this is just an example. But when we cite a quote, that's kind of similar to what Joe has mentioned. I remember a quote from Warren Buffett is, really when the tides go out, you really discover who's been swimming naked. So this is really something that resonate with all the managers that's investing in secondaries.
I was going to extend that question. That a question that I wanted to ask Neil was on infrastructure as well. I think people are relatively familiar with distinguishing between good PE managers and not so good PE managers. How do you distinguish a good infrastructure manager versus a bad one?
Yeah, I mean, as I mentioned before, I think it really comes down to how you manage your portfolio to the risk mandate that you have. Infrastructure is part of a diversified portfolio. We're not competing with private equity returns. We are there to deliver a lower risk, lower return to the client. And as I said, we've already bifurcated risk into core and core plus. And so I think really good managers are ones that stick to the mandate that they have agreed with the client. And we probably spend way too much time within Macquarie talking about mandates, but it really is one of the first things that we talk about when any deal crosses the desk is, what is the right pool of capital for this, given the risk profile of the asset? And just to build upon the question around the economic times and, again, allocations, I think infrastructure, again, is that lower risk, lower return proposition really should ride through economic cycles with less volatility. It is by definition low beta. And we've spoken about COVID. One of the best investments we've made in Asia, and one of the largest exits last year was the Air Trunk deal. That was a business that we grew substantially through our holding period as the controlling shareholder, and almost all of the core growth in that business occurred during COVID. And generally, when we look across the portfolio, the volatility of valuations in our portfolio throughout COVID was relatively muted, certainly relative to other alternatives.
So same question to Richard. I know you alluded to earlier that the longer the history, the better. It's conservatively run, longer track record, et cetera. But there's a lot of private credit managers out there. Oaktree is one of the longest. What would you say to our clients on how to kind of distinguish between good and bad private credit managers?
So go back to my earlier point. If you only have a few minutes to choose, go for history, right? Because there are young managers, there are old managers. But the old one must have gone through the different tests. And I think going through crises shows a lot, right? Because for a firm to be able to survive and navigate those, especially amongst credit, where a loss can be catastrophic, you don't have a 2x, 3x investment to make up for losses in credit. So history and their experience is very important. Then the natural extension is to also look at beyond just their credit selection capabilities, see what other tools they have. So for example, at Oaktree, we don't just invest in private credit, right? We have a very vibrant liquid credit investment team. We also have a distressed debt investment team. So during crises, we have all these different tools, different experts that we can speak to, right? So it's kind of looking at a shop, right? You want to make sure they have the different tools for different seasons and weather. And again, history is a quick way to see that, but if you drill deeper into it, see what other capabilities they have around that. And again, I mentioned the word crisis because again, where we are in the market today, look for those special qualities and look at how they have responded in previous times of tests.
Okay, this is the last question for all of you, rapid fire question, 30 seconds each. If there is another GFC type environment, what happens to your asset class? Starting with Vicky. Not infrastructure, private equity.
That's right. Obviously, in private markets in general, the benefit is we tend to outperform public equities. So this is one of the things that we will be able to say is that because of the hands-on value creation, because of the control we have over the companies, we are able to work very closely with the management and create plans to navigate long-term. We don't have to worry about quarterly reporting of earnings, et cetera. So all the plans that we create is really long-term. It helps us make the company a lot more resilient. So I'm pretty sure when a crisis comes, we'll be able to withstand a lot of the different difficulties, but because of our hands-on creation.
Okay, Neil?
Again, I think we're at the lower risk, lower return end of the spectrum. So if a GFC were to recur, it would have a lower impact on our portfolio than other areas of alternatives. And one of the benefits of infrastructure is most of the assets we invest into generate strong cash yield. So you're continuing to get dividends throughout that difficult period, and you're protected by baseline contracts.
Phil?
Maybe I'll begin. I hope we don't actually go into a GFC because that'll be negative for everybody in this room. But I think looking back into our history for AlpInvest, when we invested our Fund 3, that was actually right before GFC, invested an entire fund before GFC. That performance actually was quite resilient. And the reason is we went after quality and we went after middle market funds. I think the biggest thing is that if you think about liquidity over the next 12 to 18 months, I think it's going to be very hard if you are in a large cap fund. And the reason is most of the exits will be driven by IPO exits. Looking at what's happening in the equity market, IPOs will be very tough this year. Hopefully it opens up next year. But when you're investing in middle market funds, there's a lot more exit venues and a lot more liquidity venues. And it's also much easier to grow a business that is $50 to $100 million EBITDA to 100 to 200 instead of $1 billion to $2 billion.
Thank you. Richard?
For those who are old enough during that time, did you have a credit card during GFC? And that other question is, did you have to pay that credit card debt that you had during GFC? And I'm guessing most of you would say the answer is yes. And that is the same analogy with private credit. Because we're a credit, we have we're protected by contractual obligations. So we're the safest on the capital stack. Thank you.
Thank you very much. With that, I want to thank all the panelists here today. Thank you very much, everyone.